Let's talk about Ghana now. The country's apex bank has affirmed that as long as government of Ghana bonds continue to be liquid, liquidity risks in the country's banking industry are still controllable. In a liquid bond market, stress testing showed that most banks could tolerate daily deposit withdrawals of up to 4% over 30 days. However, they would have trouble if GOG bonds lose their liquidity. This morning, Patrick Abankwa, financial analyst and investment advisor, joins me to talk about this. Thank you so much, Patrick, for coming on.
Thank you very much once again for having me.
So can you tell us what the Bank of Ghana's recent stress test revealed about the current stability of the banking sector?
Okay, so the recent Bank of Ghana stress test, as you rightly said, underscores the importance of a liquid government of Ghana bond market in maintaining the stability of the banking sector. If you look at the details of the test, it revealed that most banks could withstand significant daily deposit withdrawals for an extended period, provided that government of Ghana bond market remains liquid. However, from the report, an illiquid bond market would or could severely compromise the banking sector liquidity, potentially leading to some systemic risks that the banks face. So that's the overarching summary of what the test report showed.
Now, having said that, Patrick, how crucial now is the liquidity of these government bonds, looking at the health of the banking sector? Are there any connections? What are the guarantees looking at the bonds and what it can offer in terms of value?
So the bonds serve as, for me, a crucial asset class for Ghanaian banks because it influences their liquidity position and their overall health, financial health. A liquid bond market enables banks to easily sell these bonds to meet their liquidity needs, especially when it comes to funding loan disbursement or honoring some customer withdrawals. So conversely, if you are looking at it, an illiquid market can restrict the bank's ability to convert bonds into cash, and that will mean that they are going to hinder the ability to meet obligations, especially when customer withdrawals are becoming a problem, and also lead to some liquidity crisis. Again, we shouldn't forget that banks are in the business of selling cash. So they take cash, they sell cash. So if they're having challenges redeeming the cash that they've sold, i.e. into government of Ghana bonds or any other instrument, that becomes a liquidity challenge and overall affect the financial service sector in Ghana, which in itself is a risk that if not managed well, it can collapse the whole economy as we speak.
How attractive is the Ghanaian bonds? Because it seems as though the liquidity of the banking sector is actually hinged on the value that this bond can provide. Is it attractive to those who are willing to invest in it?
The bond used to be very attractive until we entered into this domestic debt exchange program, which started in 2022. Since then, most institutions, especially the financial institutions, are not very keen on going into the bond. Most of them are now going into the short-term treasury bills, which is for just 3 months, 6 months. They're able to turn it around. But the bond market has not yet rebound as we saw some years back. So as we speak, it's still a bit of a dicey situation for the financial institutions. Investors are very careful. Most of them are actually waiting for the election to come through and then see whether the new government that will be formed will be able to give some assurance when it comes to bonds. So as we speak, I wouldn't say the bond market is booming. It is still in its early stage of rebound after we went through the domestic debt exchange program in 2022 and 2023.
So in advance whereby the bonds are not really performing well and we have issues with liquidity within the space, shouldn't we be seeing some sort of injections from the Apex Bank to keep the banking industry, working and afloat, depending on the time other financial instruments are optimal in terms of what they can contribute to the sector?
So I think that what Bank of Ghana has done over the period is that they are still encouraging the banks by way of ensuring that the Ministry of Finance promise through the IMF program to get some of these coupons on the bonds being paid to indeed happen. Once government begins to pay the coupons on the bonds that were restructured and people are now beginning to gain confidence, that's what Bank of Ghana can do and encourage these financial institutions and also investors to be able to go into the space. As we speak, because we are still moving out of the woods in terms of the challenges that we went through as a country and economy, Bank of Ghana's funding is a bit limited, especially when you look at the deficit position that they have to maintain for government. They don't want to go beyond that deficit position, which will have an impact on the country going forward. So it's a matter of trying to steer the ship a while until we get to a point where we say that, okay, now coupons are being paid, investors are now getting confidence, people are also bringing their funds from outside, injection into the local economy. That's where they will begin to see the market rebounding and seeing the actual growth. And that's where the liquidity that Bank of Ghana stress test will also come to play, because now we have more investors investing their funds, and there's always a turnover of cash that we can use to pay investors who also want to redeem their funds as and when they want it.
Okay, so what about debt payments to banks in Ghana by the banking customers, those who actually collected loans and are, paying it back? Could that also be probably a major factor in the bank, looking at the banking sector now, it's the ability for it to be resilient and, of course, to mitigate risks that could impact Ghana, as it were, the banking industry and the country's economic outlook?
Okay, so when you look at the debt payment to banks and the banking sector resilience, that's rightly said. I mean, while timely debt payment from customers can improve the bank's liquidity and also reduce credit risks, I think the impact of an illiquid bond market can really overshadow this positive effect, because banks may still face liquidity challenge even with timely customer payment if they cannot efficiently convert their bonds into cash, because most of them hold most of their assets in these bonds. So if they're not able to turn it into cash, no matter how customers are prompt in terms of their debt payment, when it comes to turning around some liquidity challenges, they will still struggle, because the bond form a chunk of the asset that they hold as a bank.
So what about the projected interest rates that is said to have increased to about 16 percentage points? Do you think that would have any sort of effect on the capital adequacy ratio of banks too?
I think that the interest rate has, yes, an impact. A declining interest rate can improve the bank's solvency by a number of factors. One, it helps the bank to reduce its funding costs. And what it means here is that lower interest rates can reduce the cost of funding for banks, improving their profitability over the period. Again, it also stimulates economic activity, because lower interest rate can encourage borrowers and investors to go into the banking space, look for more avenues to raise capital for their business, and that in itself boosts the economic growth and reduces credit risks. Again, if you have loans that are very expensive and people are going for the loan but they are not able to pay, it also has a deeper impact on the economy, and that leads to some kind of illiquid position for the banks. And also, as the rates drop, we are likely to see encouraging loan repayment. People who have challenges paying their loans because the rates are high will now have the leeway to now come in and pay the loan rate at a lower percentage. So I think that the lower interest rate can also incentivize borrowers to repay their loans, and also that will help to improve the whole asset quality of banks.
We also know that issue around exchange rate fluctuations could also affect those customers who actually try to pay back their loans, banks that are trying to recoup on investments, those who are trying to secure their loans or get their repayments from those who have, accessed loan finances or loan obligations from them. So when we have fluctuations in the country, how do you think they will also affect, the solvency, financial solvency of the banking industry?
Yeah, I think that to start with, I think there are some media reports that suggest that a minimal impact of exchange rate fluctuation on bank solvency, significant and sudden movement in the exchange rate, can pose a high risk, as you rightly said, especially for the banks and foreign currency exposure. And I think that such reports are quite true, because if you look at the impact of interest rate fluctuation or exchange rate fluctuation, one, it has foreign exchange losses. Depreciation of the Ghana cedi leads to foreign exchange losses on foreign-dominated assets and currencies. Two, it also increases your funding costs as an institution or a bank or the country. Banks will now face higher funding costs if need be, if they want to borrow some foreign currency to be able to shore up their liquidity. That's also going to be another challenge. Then again, because some of these customers that have taken loans from the banks are importers, they are taking goods from outside, they are buying in dollars and all of that. When the exchange rate is fluctuating, it leads to, deep impact on the ability to pay the loans, because now they won't have the exact amount of money that they need to get their goods, sell it, make profit, and pay their loans. And that's also something that can lead to increased loan default over the period. So it has a very dire effect on the economy and also the asset base of banks if you don't manage the exchange rate fluctuations over the period, because that will have a deep impact on the bank solvency.
Okay. Patrick Abankwa, financial analyst, thank you so much for sharing your thoughts with us. We appreciate that.